For introduction, Professor Edward Altman is known for the development of the Altman Z-score. And as a background, the Altman Z-score is an effective measurement of the financial health of a company and a powerful diagnostic tool that forecasts the probability of company entering bankruptcy. He also has an international reputation as an expert on corporate bankruptcy, high-yield bonds, distressed debt, and credit risk analysis. Today, as the COVID-19 hit economy and affect the global market, the topics 50 years of Z-score, what have we learned on COVID-19 and the credit cycle, will provide insights to answer critical questions for both global academia and professionals. I would like to welcome Professor Ed and thank you for joining the Keynote Speaker Series at Columbia Restructuring and Distressed Investing Group.
Well, thank you very much, Tony. Good afternoon, everyone. It's a great pleasure, really a great pleasure for someone from your downtown competition to be invited to such a important group and at an important time. As some of you may know, but perhaps not all of you, I've been teaching at NYU for about 100 years now, but actually it's not that, but it's close. I've been at NYU for 53 years, and I haven't been able to figure out how to get another job, so I'm still there as an emeritus professor at this point, which means that I still teach some, but my paycheck is much, much lower. But it's been a great experience for me to be in New York at NYU and periodically having interactions with a number of faculty and students at Columbia. Today, in addition to a shout out to Columbia Restructuring and Distressed Debt Group, I'd like to say hello also to the Stanford Business School course in restructuring. It's a brand new course being taught by a friend of mine, Mike Harmon, and Claudia there. And I'm pleased to be speaking to them as well in the future. So today we've got a lot of ground to cover. Fortunately, we have about an hour or so, and then some Q&A that some of you have already participated in, and perhaps others would like to. We're going to cover, as the title page shows, two main topics. They're quite related. One is a 50-year retrospective on our family of models that we built over the years, known as the Z-score, and what have we learned and what have we not learned from them. And then to move on to the more current issues of COVID-19 and the credit cycle. So we're going to cover more than 50 years of research, teaching, consulting, etc. experience in a little over 50 minutes. So please fasten your safety belts as we go through this. At the same time, I'd be happy to answer any questions, primarily after I'm done, since there's a large audience and I don't want to take away from some of the material at the end, which you might be interested in. Next slide, please. So first, a little history, a very quick ride through credit scoring systems and their development over time. You could actually go back to the medieval days when credit was important for the Crusades, as the Crusaders went across Europe, etc., and needing credit in the various lodgings, not wanting to carry money with them, and being hijacked by pirates, etc. So there was a need for credit systems then. But the modern system, so to speak, began in the 1800s in the United States with respect to qualitative systems, mainly issues as the quality of management, the CEO, the product, location, and very little in the way of financial data. Fast forward to the early 20th century when the rating agencies were formed, Moody's, Standard & Poor's, later on Fitch, and certain far-sighted companies like DuPont putting together scoring systems in a very primitive way, in a sense that looking at a number of indicators one at a time. And that was the state of the art until the mid-1960s. And I was very fortunate to be in the right place at the right time, and I'll go through that in a moment, to develop the Z-score model in 1967 as a PhD student at UCLA, and then published in 1968 in the Journal of Finance, and using, for the first time, a multivariate accounting and market measures to try to enhance the information content of accounting numbers. The techniques that were used by myself and subsequently to that have been a large number, starting from discriminant analysis, logit analysis, which is the type of regression that some of you may be familiar with, probit, logit models, linear, nonlinear models. Then there were some black box attempts. We built a model in the 1980s called recursive partitioning techniques, neural networks in the 90s, machine learning. There's been a whole explosion, if you will, of mathematical statistical techniques, all with the ultimate objective to predict the health of companies, and particularly whether or not they would default or go bankrupt. They've been applications in consumers, manufacturing firms, across the spectrum of industrials, efforts in the private firm area, as well as emerging markets, and all banks now, literally all banks of almost any size, have some sort of scoring system internally developed or developed by consultants or taken off the shelf from others like my own and Merton models, et cetera, because they have to, of course, deal with the issue of expected defaults and expected losses under Basel's capital requirements. SMEs, small and medium-sized firms, is a particularly important area in my research of late. And indeed, we have developed a company in London called Wiser Funding to exploit models, particularly emphasizing the health and likelihood of default of small and medium-sized firms. Next slide. Option continuing claims, as you may have covered in your finance courses, from the earlier models of Merton and Wilcox, dealing mainly with the issue of market value of outstanding securities and their volatility and leverage levels. And that was popularized and made commercially successful by a firm called KMV in the early 90s. They eventually sold their model to Moody's, so it's now being actively done there. And it's usually a structural model that has been adopted by a number of practitioners, but importantly also by academics in their research. All sorts of techniques, as I mentioned. The current fad, if you will, is on what's called blended models, which combine financial data, market value data, governance data, data from invoices, et cetera, a combination of many different inputs. This has been adopted by various institutions, including our work at Wiser Funding. Indeed, we've come full circle in a sense that we've begun to appreciate, again, qualitative factors as well as quantitative factors in predicting financial health of companies. I can explore that a little bit later on if I have time. Next slide. Now, let me take you back to the mid-1960s for the development of the Z-score model. And what was it like doing empirical research in corporate finance back in the so-called Stone Age when I was a graduate student. I think it's important to understand how we did it then and how you might do it now, so to speak, in building these models. First, back then, there was a fortuitous combination of factors that I was very fortunate to be in the right place at the right time. Because in the early and mid 1960s, we had the introduction of mainframe computers on college campuses like UCLA to do research outside of the physical sciences and the medical sciences, which had been done with large computers in the past. But now it was available across the board, mainly in the social science as areas as well. And so I'm convinced that if I was a graduate student back before 1965, I wouldn't have had the computer power to build the model that we did. And frankly, 2 years later, I probably would have been too late. Somebody else would have done it. So timing is really important when it comes to new research. What about databases? Well, there were no databases then to speak of. You couldn't look up data in Capital IQ or CompuStat or even purchase it from companies like KBRA, which I'm affiliated with now, and Harry Mamoski on your faculty is as well, in terms of developing and maintaining databases. There are many databases available from the rating agencies, from software programs. But in those days, if you wanted to do empirical research on companies, you had to go to either the original sources, which were annual reports at that time. There wasn't any online government sources. Or you went to these big, giant tomes called Moody's Industrial Manuals or S&P manuals. And you gathered the data, then you punched it out on these, I don't know how many of you ever heard of a punch card. I know there was a few in the audience with gray hair that probably remember it. And maybe some of the current students have had the important experience of dealing with punch cards. But basically, you punch the data that you gathered onto cards, put it into a box that had a source program, lifted it up. It was good for bodybuilding. You went across campus, delivered it to the mainframe mother computer, and then you went to church, synagogue, or mosque, and you prayed that you got results. Because typically, especially if you were like me, you made some mistakes in punching the data, or you've heard of the famous punch cards being bent or hanging charts or whatever you want to call it. But in any case, it didn't work and you had to do it again. And every time you tried a new model with perhaps different variables or different firms, you had to have a different box and you had to punch the data again, go across the. But I can tell you, I was really very, very fortunate to be there then and having a faculty member, a new faculty member who had some experience working with discriminant analysis, which is a statistical program to discriminate between groupings of firms or groupings of observations, in this case, based on bankrupt or non-bankrupt companies. I started out with only manufacturing firms, publicly owned companies. There weren't many bankruptcies back then, so the sample size was quite small. They were relatively small firms. Those that were decent sized firms for that age, but small compared to current situation. And we developed that model, which I'll get into in a moment. And so let's talk about the development of the Z-score and what have we learned. Next slide. Indeed, the development of Z-scores went from the original manufacturing publicly owned companies in the United States to Zeta scores, which were for non-manufacturing as well as manufacturing, much more larger sample, more robust across industry sectors. combining with cost of error determination, which I'll get into. This was supplemented with, very importantly, in 1989, when an article I wrote for the Journal of Finance dealing with the concept of mortality rates. And these are actuarial techniques used to estimate the probability, not whether or not it's classified as bankrupt or not, but the probability that it's going to go bankrupt or not, which is, of course, the holy grail when it comes to credit scoring, probability estimates, and therefore talking about the likelihood of default or non-default and the cost of those errors. And we developed cumulative default and loss rate distributions from birth of the product, and I'll get into that. Eventually, we moved on to emerging markets, small and medium-sized firms. Next slide. And always, very importantly, referring to the standard nomenclature of rating agencies. Now, rating agencies, that's a separate topic for us to talk about, the pros and cons of rating agencies and their business model and the output and the efficacy and accuracy and timeliness of those ratings. But there's nothing more important for us researchers than long time series of data, and data that you can use to come up with some solutions that you're looking for. So you look at the standard Moody's and S&P nomenclature, breaking up companies into investment grade or non-investment grade, sometimes called high yield or junk bonds. Now, I was very fortunate. There's a couple of times in my career that you could say were milestones in terms of exposing me to certain areas. And one of those was early 1980s, having the opportunity to study the junk bond, high yield bond industry. I was asked by a large investment bank at that time, Morgan Stanley, still around, to build up some data and analysis for them to make a very fundamental decision. Should we get involved with this new market called junk bonds, which was being developed at the time from a very small level by the firm of Drexel Burnham, pioneered by the visionary in that field, Michael Milken. Next slide. Okay, so I'm going to come back to the use of ratings in a very important way and how we've used it in our Z-score analysis. Here is the original Z-score model. Some of you are familiar with it. Some of you have heard of it but are not familiar with it. And some of you haven't heard of either one. I don't have time to go through all the derivation, but we looked at about 25 different indicators at the time. We were a team of one and therefore had limited data and limited resources. But we looked at a fairly large number of traditional financial measures and a few new ones that hadn't been in the literature or hadn't been used before in credit risk analysis. And I'd like to focus on two of them, X2 and X4. The retained earnings to total assets, that had not been used before, even though it is their standard accounts on the balance sheet, measuring cumulative profitability of a company minus their dividend payout over time, very much influenced by earnings of companies and their success, but over time as opposed to at one point. And the fourth variable was the first time in credit scoring analysis using the market value of equity rather than the book value as a measure of the equity of a company. Very importantly, this added a futuristic dimension to the model, which had not been done before in any of the more traditional studies on credit risk. But I always relate market value of equity to the book liabilities because that's what the company has to pay. Otherwise, it defaults or has some financial distress. 5 variables, you can see what they are. some traditional, some not so traditional, but all coming from financial statements. The weighting factors were determined by a computer program, not by me. Although I chose the firms and the variables to look at, the actual algorithm for coming up with the final Z-score model was chosen by the computer that best discriminated between the bankrupt and non-bankrupt companies. By the way, you're not limited to two groups. You can do more than two groups. You can try to, for example, predict default, non-default, and delinquency as a third category. Or you might try to replicate the bond ratings. And they are all indiscriminate analysis. The dependent variable is qualitative in nature as opposed to quantitative. Next slide. So back in the 60s, and don't forget, this was research that was originally oriented toward academics, but I knew the reader, especially if one was going to use it in a practical way or try to replicate it themselves and compare it with their own models, would need some guidance as to what the score meant. And the scores, of course, could vary from negative scores up to 10, 15, 20 level. But I found that originally scores above 2.99 were consistent with companies that never went bankrupt. And scores below 1.8, 100% of them in our sample and our holdout sample went bankrupt. And in between was the so-called gray zone. And these were companies that it was less clear whether they were going to survive or not. But for the most part, using an artificial cutoff score that I selected in that gray zone, the accuracy level was very high. Now that was the 1960s, and the sample of companies was from that era. Now, unfortunately, and I say this with all sincerity, because my experience is when you write something, especially something that has caught on and people still use it, they go back to the source and they see that we published these zones. But ladies and gentlemen, these zones are no longer relevant in today's market, but they're still being used. And I get a lot of hate mail or flack or whatever you want to call it for calling a distressed firm likely to go bankrupt when their score drops below 1.8, when in today's market, that's a decent score. I mean, it's not a great score, but it's a decent score. I'll show you what I mean in a moment. Next slide. The accuracy levels were quite good, in the mid 90%, 1 year before data, before bankruptcy, and 70 to 80% 2 years before. And remarkably, that accuracy level was even better in holdout samples. Those are companies not used to build a model, but tested on it, but also standing the test of time. So we concluded, and I can show you this in many cases in our textbook, et cetera, somewhere about 80% accurate within 2 years, 80, 85% type 1 accuracy. And type 2 accuracy, very high, but also with a lot of errors lately in type 2, meaning we think that the company using the old methodology is going to be distressed, but it doesn't fail. And I'll show you why. Next slide. Moving from, let me see, go to the next slide, Tony, for a moment. I want to see something. Next slide after that. Okay, yeah, go back now, 2 slides. I'll embellish something that I probably should have had in there. One more slide back. Okay, now what I mentioned about that Z-scores are no longer, cutoff scores are no longer as relevant. If you go to the next slide, Tony, you'll see one way of adapting the scoring model over time to different environments. So periodically what we do is we estimate the bond rating equivalent of the Z-scores. And we do that, we've done that now 6 times in the past, going back to the early 90s, to try to see if there's an evolution of credit risk over time. And I'm convinced there is an evolution, a big one, in the United States economy. For one thing, back in the 1960s when we built the model, there were no such things as high yield bonds, leveraged loans. Shadow banking was maybe there in some form, but very little. Take a guess today, how much loans are outstanding from non-bank, non-capital market companies issuing bonds or loans? How much of the credit market is being provided by what's called shadow banks? These are BDCs, business development companies, hedge funds, companies that make loans directly to the companies that are not regulated by the government and essentially have provided important sources of capital, particularly for lower quality companies, the so-called leveraged loan, high yield bond type companies, but smaller ones. If your answer was close to $1 trillion, you'd be correct. And that's up from just a couple hundred billion 10 years ago. And so that is a source of credit. Junk bonds today are about 2 trillion in outstanding, and leveraged loans about 1.5 trillion. So we're talking about leverage finance big time in the economy. So these bond rating equivalents are a way of transforming the score into a credit metric that we have some experience with. Notice I combined AAA and AA. Well, one reason is there are almost no AAAs left. Take a guess how many are left in the United States, in the world, among corporations. By the way, no banks are AAA anymore. But when you come to corporations, believe it or not, there are 2 left in the United States: Microsoft and Johnson & Johnson. That's it. And there were about 100 back in the early 1990s. So we calculate the bond rating equivalent. So for example, the AAA, AA around 5.5 lately, 5.2 for A. Look at the B-rated category. 2.11 was the median B-rated category. That's in the left-hand column there, second column there, left-hand side. 2.11 in a most recent summary, based on 72 companies that we looked at, was the median. 2.11, if you go back to the zones, was deep into the distress zone, you know, back in the 60s. Today, it's the dominant junk bond. There are more Bs than any other category. And 2.11 today, and I'll ask you this question in a moment, but think about this as I'm talking. If you see a company with a B rating, what do you think the probability of it defaulting, say over the normal business cycle, within 5 years? Okay, that's, if I had a polling, I know we could do that with Zoom polling question. What proportion of B-rated companies, when they come out, when they are first issued, default by the 5th year? And you might ask the same question for triple Cs. Notice that the D category at the bottom there, default, lately has had a median score for many, many years now of about 0. So I think 0 is a much more accurate barometer of a firm in deep distress and likely to default than originally below 1.8, which was that original cutoff score. Next slide. Here again is the growth of that high yield bond market from the late 70s to the current situation of close to $2 trillion. Huge increase, as you can see, in 2020. I'm going to come back to that issue. Next slide. How to estimate the probability of default? Well, there are two techniques that I've used, and the method number 2 is one that most researchers now use. But I like the method 1. I like them both actually, but I like the method 1 a little bit better. First, you start out with a credit scoring model, ZScore, or perhaps a Merton score, which is K&B score, or you may use a scoring model from Moody's or S&P in their consulting. By the way, rating agencies do not use models to ascribe a rating, but they sell models in their consulting activity. And obviously, they probably can look at the results of the model, but they try to separate the two. Otherwise, there's people are confused as to what's the criteria for the rating. Then you take that score and you ascribe a bond rating equivalent. And from that, you end up with inputs for estimating the mortality of the bond on either new bonds or existing issues. And you utilize that mortality rate to estimate marginal and cumulative defaults. And estimating default recoveries and probability of loss is the final product, which of course is critical for Basel II estimation, but it's also critical for a number of applications, which I'll get into. The second method deals directly with a statistical technique called logit analysis, and you directly estimate a score between 0 and 1, which is then transformed into a probability of default. And then based on that, you can estimate recoveries and loss given default. Next slide. Here are the, for those of you more quantitatively interested and with an insurance background, are the marginal and cumulative formulas for an actuarial approach. Quite intuitively logical. The percent of debt, defaulting debt, and I always use dollars rather than companies as my metric. The rating agencies now mainly do companies, but they probably have learned from our studies, and they also use dollar amounts. So the total value of defaulting debt in a year relative to the population at the start of the year of a given rating class. So we can estimate marginal and then later on cumulative defaults by original rating. So just like insurance actuaries look at people and look at the original characteristics of people, like gender, what's the average life expectancy of a male born today in the United States versus a female? And we can go into that, but we can estimate that. But you know, if the baby lives for 1 year or the bond lives for 1 year, its probability of surviving the next year or up to a certain period of time in the future changes. It's called contingent probability. Contingent on survival, how much does the firm likely to last going forward? Next slide. The bottom line from all of this, and I hope you can see this, and by the way, the PowerPoint presentation is available from the Restructuring and Distressed Debt Club. Tony will make it available to you if you ask him nicely, but I'm sure that that's the case. This matrix shows the current compilation. We update this every year, starting in 1989 when we built the model, of new issues by bond rating and the marginal and cumulative probability of default 1 to 10 years after issuance, from AAA down to CCC. So now I can ask that question again that I asked before. What percentage of new issue Bs, which is the dominant junk bond today, are likely to default by the 5th year? Well, if you said 27.8 or 86%, it's a little small there for me to see, you would have been correct. That's the actual cumulative mortality rate. And the equations are a little bit different than simply summing up the marginals. I won't get into that now. For 5 years for a single B. Now remember, the single B has an average Z-score of about 2.1 today. And 2.1 was in the distress zone back in the 60s. No longer is a B a distressed company, highly distressed. Yes, you know, companies do default from B, go to default, but most get downgraded to triple C first, or the B-rated categories, multiple downgrades before they default. Anyway, 27.86% by the 5th year. That means about 72% do not default. And if you compound the interest that you earn over that 5-year period and compare it with the expected loss, factoring in recoveries. Let's see, next slide, please. Yeah, so if you look at this table, we factored into, by the way, this analysis was on over 3,000 defaulting issues to get an expected loss, and 3,600 issues in terms of expected default. You can see by the 5th year, you lose about 20% of your money. By the way, this table is incredibly potentially helpful if you're trying to decide, should you invest in, for example, triple B rated bonds. And you see triple B rated bonds, you can lose on average about 3% of your money by the 5th year. And then you have to compare it with the compound triple B rate of return over 5 years. But with respect to Bs, the numbers come out to be quite favorable to invest in Bs, even though the default rate is quite high, 28%, and the loss rate about 20%. So you can use this data to analyze different rating class investments, taking into consideration expected default and loss and compound interest over the period of time based on the yield that is being provided. Next slide. We've also built a model for non-manufacturing companies that we find more accurate than the manufacturing model. It's a 4-variable model with a constant term this time. It's based on, however, data from manufacturing firms and then adopted for non-manufacturing firms. We used it first for emerging markets. So I recommend you use this model if you're analyzing companies like from Brazil, Mexico, Asia, etc. Next slide. The bond rating equivalents of the Z double prime are given here. I won't go into them with pluses and minuses. So you again can use a score, a bond rating equivalent, and go from that, input it into the matrix that I just showed you, and come up with a PD. That to me is one way of doing it. The alternative way and the easier way, but not necessarily more accurate, is the using the logit regression approach. Next slide. Let me show you an example of a non-manufacturing company, Sears Roebuck, and the different inputs that you might get from Z-score or from Z double prime. So you can see that the Z-score, the dotted line, Z double prime score, the dotted line, had a D bond rating equivalent in 2016. The company went bankrupt, and as many of you probably know, a big retail company like Sears in October 2018. So almost 2 years before. Whereas the Z model, still quite good in terms of trend analysis, had it as a B- bond rating equivalent back in 2016. Next slide. Let's talk about applications now. This is a table that I've compiled over the years. And I must tell you that when you have a model that is being used by practitioners, you get an awful lot of great feedback from them, particularly if they are thoughtful practitioners, which many of them are, as to perhaps applications that you never thought of when you developed the model. So the left-hand side deal with external to the firm analytics. These are potential users of the model. And by the way, just to give you an idea of the model's popularity, and you know, I'm as surprised as anyone that the model is still being used today as much as it is after more than 50 years. But Mr. Bloomberg tells me that they get more than 5,000 hits per day on the ZScore page. And surprisingly, by the way, the majority of them are from equity investors rather than debt investors, which surprised me. And I believe that the model is as popular as it is today for three main reasons. I should have said this earlier. I don't want to distract from the applications, but the three reasons are that I found: one, it's simple, easy to calculate. You don't, yeah, you can go to Bloomberg or Reuters or Capital IQ and get the Z-score directly from them. Some of them calculate it a bit incorrectly, but basically okay. Or you can do it yourself. It'll take you about 20 minutes with a handheld calculator or computer and a balance sheet and income statement. And you can write programs, and my graduate assistants do all the time. I'm sure you could do it, to filter thousands of companies very quickly by simply inputting the formula into large databases. So let's talk about the external applications very quickly. Lenders, obviously, banks, insurance companies, shadow banks could use it not only to predict default or not, but in their pricing and their Basel capital allocation. Bond investors, well, we're working on a new model called quality junk. And I think you could use Z-scores as well as other techniques, which I won't get into today because it's our secret sauce, with respect to building what I call quality junk portfolios. Quality junk portfolio simply means investing in high yielding, higher risk companies where you're quite confident that the firm is not going to default. I think that is a winning combination. Equity investing, long short investment strategies. Did you know that Goldman Sachs has a product called strong balance sheet, weak balance sheets, which is based on buying the top 10% Z-scores and selling short the bottom 10% in a basket of companies? And they've had this product available for investors since 2008. So we're talking about more than 10 years. And you know that Goldman Sachs would not have a product for more than 10 years if it wasn't found to be helpful to the investors and sold pretty well. You can build bespoke models with various levels of cutoff scores. STOXX, for those of you with a European background, know that's like the STOXX 600 is like the S&P 500 here, but for European companies. Nomura, Morgan Stanley, a bunch of others have used Z-score in some of their equity evaluations. Security analysts, regulators, government agencies. Did you know that you must pass a Z-score test to be, at least you used to, I'm not sure if it's still the case, to be a vendor to the Department of Defense in the United States? It's not the only technique, but it is one of the screening devices that the DoD uses to select vendors. Auditors, you know, auditors have to give a going concern qualification if they don't think the company is going to be around in the next, throughout the end of the next accounting period. Advisors to the companies, mergers and acquisitions. McKinsey just did a study and I highly recommend those of you interested in the concept of corporate resiliency. And as a restructuring club, I would guess you would be, because one thing is important to know in restructuring is, when does the firm need restructuring and how to go about it? That's, of course, a great subject, and I'll mention that in distressed debt investing. Finally, COVID-19 assessment. I'm going to get to that at the end of my discussion, dealing with BBB rated bonds, an enormously growing market of external bond issues in the United States and abroad. The right-hand side, internal to the firm analytics, used by management, used by boards of directors, used by internal credit offices. The first one on the top is an intriguing experience, and I'd like to give you a 3-minute discussion of that. To file or not to file, that is the question. I think it was William Shakespeare who first said that. Just kidding. But the example I'm going to give you was a real live personal experience I had with General Motors. Next slide. I'll come back to that slide in a moment. So let me take you back to General Motors' odyssey in survival. And we go back to 2005, when the Z-score was a score of about 1 and had a CCC plus bond rating equivalent. It was rated at that time BBB, investment grade. And I argued then GM did not look like an investment grade company. And then you can see that next couple of years it deteriorated. And then in 2008, on December 2nd, I received a phone call. I was at a conference in Florida, and actually a board meeting in Florida, and on the line was the ranking minority leader of the House of Representatives Finance Committee. And he was asking, would I be willing to testify in Congress at a hearing coming up as to whether or not General Motors should be bailed out, as well as Chrysler Corporation, and with interest, but not directly being petitioned to bail out by Ford Motor Company. As you may know, the US automobile industry was in a heightened distress situation during the early stages of the great financial crisis. And a company like General Motors had been particularly hard hit in its competition. It no longer was the largest selling automobile company in the world, forfeiting its first place to Toyota. And secondly, it had been hemorrhaging cash by around $2 billion per month. And I asked the congressman, when did you want me to testify? And he said, Friday, and it was Monday. So I had 3 days. I said, well, what's involved? He said, well, you have to prepare a testimony. It could be any length, and you have 5 minutes to present it to the House. And then there's Q&A on the part of the congressman. It's a very large committee at that time, chaired by a fairly famous congressman, Barney Frank. You've probably heard of Dodd-Frank. This was the Frank from Dodd-Frank. So I said, okay, I had been thinking about GN. I called my graduate assistant, got the latest number, and the latest number was in the negative zone, minus 0.6 actually, around that minus 0.35, which is what it was in December of 2008. So I was pretty convinced that General Motors on its own could have defaulted and certainly defaulted and possibly gone bankrupt. But General Motors was an American icon, was a huge multinational company, and wasn't easily going to go bankrupt. But I argued, and I was the only one on the panel, along with the CEOs of the 3 companies in a separate panel, the only one who advocated that GM go bankrupt immediately. It's the only way I felt to save the company and to be qualified for restructuring under the Chapter 11 bankruptcy system. Well, I was not very popular with the congressman. In fact, I don't know if you'd call it I was booed, but I was not very popular because the congressman did not want to oversee a situation where an American icon like General Motors went bankrupt during a great financial crisis. Well, the House voted to continue to bail out GM and Chrysler, but the Senate voted against it for technical and conservative reasons, not because of ZScore. Well, it turned out that George Bush, the president at that time, in one of the last things he did before leaving the presidency, bailed out GM and Chrysler with a $15 billion bailout. And now he said it's Obama's problem. And it was Obama's problem. And Obama did a fantastic job appointing a committee of practitioners to oversee the restructuring of the automobile industry. But GM, despite some attempts at restructuring, including assigning a new CEO, getting rid of the old one, which is important. But the new CEO was one of the old timers in the company, and he just more or less continued in a slightly different way, the old way of doing things. And then finally, on June 1st, 2009, probably the happiest day in my professional life, GM filed for bankruptcy. I was overjoyed because I felt strongly that was the only way to save that company. And they needed to restructure. And you probably know during restructuring in Chapter 11, you are eligible for what's called debtor in possession financing, DIP financing, which is an American innovation. It's now being copied in various ways by a number of other countries in their bankruptcy code for providing liquidity of companies during their restructuring. In my testimony, I advocated $50 billion for GM, and the only institution strong enough at that time to provide $50 billion was the US government. And so I advocated the US government give them $50 billion. This was in December. In June of 2009, they went bankrupt, and guess what? They got close to $50 billion in DIP financing. And the reason they got $50 billion is they needed to restructure. And when you restructure, you usually sell assets, convert debt to equity, as you know, an equity for debt swap, which they did both of them. But you need time to do it. The remarkable thing is GM restructured in 43 days, where normally a company of that size takes at least 2 years. So I was surprised with that, as were most of the bankruptcy lawyers and judges involved. The rest is history. The company restructured, came out of bankruptcy in July, formally came out of full emergence in 2011, and the ZScore showed its improvement. Although, let me tell you, I think today GM looks like a B- triple C company. Its rating, check it out, triple B-. It's investment grade. And it's certainly doing very well, particularly in China, and now beginning to do well with electric cars there. The point I want to make is GM restructured in bankruptcy, came out as a much stronger, leaner company. And there are countless cases like that. Look at every airline out there now of any major size, with the exception of Southwest, that didn't go through bankruptcy. They all did. Bankruptcy is a very important aspect of our economic and financial system. Tony, could you go back to the slide before this? Okay, there are a number of other applications. I don't have time to go through them now. You can view them yourselves. Accounts receivable management, procurement management, sovereign default risk assessment. The last one on the right is something that I recommend all of you as members of the restructuring club or perhaps professionals in the field to think about. And that is, can management of a company, not outside advisors, not boards of directors necessarily, not necessarily government officials, but managers on a day-to-day, week-to-week, strategic as well as tactical process, use a model like ZScore or some other model similar to actually manage a financial turnaround. And that's what in our new book with Wei Wang and Edie Hotchkiss, we outline a case study where the management used it to guide them in their turnaround strategy and not doing anything unless it would improve the Z-score, which would then hopefully forecast that they would not go bankrupt. I learned a lot. I didn't come up with that application. The CEO of this company, GTI Corporation, was the one who innovated using that model. Okay, let's move on now. Next slide and the slide after. Okay, the last subject I want to cover, and I have about 10 minutes to do it, and then we can have a Q&A, but hopefully a lot of the questions that have been posed have been answered, deals with COVID-19 and the credit cycle. Normally I give this presentation and it takes 45 minutes, so we don't have that much time, but I hope you're still with me and interested in this subject. And there are 90 of you out there anyway who have hung in there. Next slide. I think it's really important when you study a crisis like we're in and have been, that you look at what the situation was before the crisis started in order to understand what's happened since. Before the crisis, at the end of 2019, we were in a benign credit cycle. We were, however, in my opinion, quite vulnerable if there would be a downturn, without knowing what the downturn would be, the catalyst. I believe that then there was the buildup of corporate debt to a great level, and I'll show you some data. There also was an enormous growth in BBB rated bonds, again, before the pandemic, and there was already existing a concept which is getting quite popular in the popular press called zombies. These are firms kept artificially alive in one form or another, where perhaps they should have already gone bankrupt. That was the situation before, and I'll show you some data. We're going to cover after what happened in March of this year. The benign credit cycle ended. What happened with the Federal Reserve and congressional actions to stave off what could have been a very serious depression in the United States. The subsequent incredible, great market rebound and its relationship to the real economy. Unprecedented actions on the part of the Fed and potentially unintended consequences. Are we building a new debt bubble? We'll talk about very briefly some data on bankruptcies and defaults in 2020 and recovery rates. Next slide. We look at 5 factors to determine where we are in the credit cycle. Default rates, recovery rates, required risk premiums, something called a distress ratio, which is the percent of firms selling more than 10% above the risk-free rate in terms of the yield spread, and liquidity in the market. All of those were saying we were in a benign cycle in 2019 and had been for 10 years or more, the longest in the history of modern financial markets. Next slide. This is a very important slide, so let's go through it carefully. The blue line represents non-financial corporate debt as a percentage of GDP. The red dotted line represents default rates in the high yield bond market. We always refer to the high yield bond market because that's the market that is most vulnerable to defaults. Notice that there were 3 peaks in the debt to GDP of non-financial companies in 1991, 01, 02, and 07, 08. Now, Harry Mamoski, who's on the line, so to speak here, has done some work with normalizing that data. But everyone agrees that those were peaks in debt levels. And everyone should agree and observe that in every case, there was a spike in default rates just after the peak. Now, they were coincident, as I'll show you, with economic recessions. But the point was the debt levels had been built up to very high levels, waiting, so to speak, for a recession. Didn't have to happen right away. It did. Now you look on the right-hand side of the graph and you see that we are in a new peak, by far the largest peak ever. And we are beginning to see in 2020 a spike in default rates. We didn't see it through 2019. And so our guard was let down in many cases. Next slide. This shows that same data, only the relationship with the yellow bars representing recessions. And in every case of late, when we had a recession, coincident with peak levels of debt from a complacency risk-on environment of the benign cycle before it, we had a spike in default rates to record, well, not record levels always, but very high levels of above 10% in 1 or 2 years. And that happened in 1991, 01, 02, and again in 09. And then fast forward to the right-hand side, you can see the current recession, which started in February of this year. So we're now in the 10th month, or not 9th month. We're finding that while default rates are rising, they're not rising as much as perhaps some of us predicted, but they are certainly rising. And many of us believe there's going to be a second wave of defaults, but probably not until late 2021, because we are now experiencing, temporarily anyway, the results of the stimulus package and the Fed intervention. Next slide. Okay, I don't have time to go through our forecasting model, but we use 3 techniques. A number of other practitioners use different techniques. Let's go to our forecast. Next slide. This is the mortality rate approach again. We use that to estimate defaults as well as by different bond ratings and when they were issued. Next slide. This is the relationship between yield spreads and default rates, a regression relationship showing a pretty high R square of 0.6. The yield spread today versus the default rate next year. Same thing, next slide with next slide, Tony, thank you. Sorry, go back one. The relationship between the distress ratio today and the yield spread, the default rate 1 year from now. We use all those techniques and then we come up with our forecast. Next slide. Well, here you see forecasts by myself for the investment banks and for rating agencies, including Fitch, Moody's, S&P, and KBRA, Kroll Bond Rating Agency. And at various points in time this year, our forecasts were done. My latest forecast is about 6.5%, 7.5% by the end of the year. I don't think we may or may not get there, but as I said, it's been slowed down. I don't know the latest from the various investment banks, but these were ones pretty recently by either the end of the year or within 12 months, 9, 10%, except for Fitch being on the low side, but probably ending up going to be the most accurate. And those are the various forecasts. All of them quite a bit higher than it was in 2019, when it was about 2.7%, at least our calculation. So they're up to, whether it would be 6%, 7%, 8% this year. By the way, someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently. So that, if you're wrong, you can make changes. Well, I've learned a bit about that. I do it when I have major talks to give or quarterly, but some of the rating agencies, change every month. A lot of the forecasts still are predicting as much as 20% cumulatively for 2 years. This is all happening despite the fact that the stock market is booming. The bond market is recovered to a normal level. It's quite astounding. Next slide. This shows our numbers on bankruptcies. Large firm bankruptcies of 100 million or more on the left and $1 billion or more on the right. These are liabilities of the companies. I always look at liabilities, never at assets. I think assets are misleading when it comes to companies because they usually book value the assets and don't reflect their economic value. But liabilities, they're real. On the left-hand side, you see that as of October 31st of this year, there were 161 companies in the United States with liabilities more than 100 million that filed for bankruptcy. If you extrapolate that number, you'll get 188. It probably will be lower than that, but it's certainly going to be at least 170. The highest year ever before was 153 in 2009, and the average and medium are much lower. Right-hand side, number of Chapter 11s greater than $1 billion, 54 at the end of October 31st. Now it's up to about 56. Extrapolated number in the low 60s. The highest year ever was 49. Now, a big question is how many of those were due to COVID-19? And how many were due to enormous buildup in debt before COVID-19? And I think both are very important, both. And we can go through the names, but of course, one of the main industries with more than 1/3 of the big bankruptcies is oil and gas. And oil and gas was suffering even back in 2019, but now they're suffering. Although you would think that the price of oil, which is around $40 a barrel or so, would be a problem in itself, and that is a big problem. But it was somewhat reflecting the expected demand in a recessionary period. But things are getting better economically, at least in the U.S., and still we're having a lot of these big bankruptcies. But it's slowing down. Next slide. Okay, I'm going to skip over this. This shows the weekly progress during COVID-19 and our extrapolation to $63 billion bankruptcies compared to 49 in 2009 and 36 in 2002. And you can see the big increase started, at least in COVID-19 period, in March of this year. Next slide. This shows recovery rates. Now, you're probably tired of listening to me, and you certainly don't want to see any more equations. But for those of you statistically oriented, this is an equation between default rates and recovery rates. Recovery rates measured by the price of the debt outstanding, these are bonds, just after default. There are other ways of defining recoveries, but that's the way we do it. And notice this, a huge, significant negative correlation, negative association between default rates and recovery rates. So for example, on the right-hand side, all of those observations are in high default periods. 5 particular years of 10% or more in default rates, and recovery rates between 25 and 35 cents on the dollar for corporate bonds. Upper left-hand side are the low default periods. And notice the conglomeration there, the aggregation of many of the years when the default rates were low, below 2%, and recovery rates were 55, 60, 65%, much higher than the historic average of 45 cents on the dollar. An application of this analysis is, suppose our forecast was 8%. And you go up to the regression lines, both linear and nonlinear, you're going to get, for the most part, estimates of recoveries of low 30%. And as of the end of October, believe it or not, the actual average recovery rate weighted by the amount outstanding of the bonds was 31 cents on the dollar, 31 cents. Exactly, more or less, what the regression line would have predicted. Very important for loss given default, for credit default swaps, and a number of other applications that use recovery rates importantly. And it's also important for distressed debt investing, which is one of the objectives of your club. A distressed debt investor loves lots of bankruptcies, loves companies, bonds selling in the 20s and the 30s. Because if they're right about the restructuring, those companies can go back to having debt levels much higher, either through the restructuring or simply by the prospect of a successful restructuring. Next slide. Triple Bs, and I know I'm just about out of time, so appreciate your patience. Triple Bs, look at the growth from $500 billion to $3.5 trillion in 15 years. A very important part, probably the rating of choice of corporate America. Now, we looked at it in 2019 and we said, what percentage of them are likely to be downgraded to junk during a downturn without even knowing what the downturn would be? And so we devised a test using our ZScore model. Next slide. And we concluded that around 35% of the existing triple Bs at the end of 2019, before the crisis, had a financial profile that did not look like triple B, but less than double B or B. 35%. Now, we know that 35% will not be downgraded, but the rating agencies all said, or most of them said anyway, that it would be maybe 10% over 2 years. I thought it would be higher, but I don't make the decision on downgrades. It's made by the rating agencies. Next slide. Let's see what happened. Now, I did this a while ago, but you could update it. This is a list of triple Bs that have been downgraded. Ford, Occidental Petroleum, Continental Resources, Delta Airlines, Macy's, Marks and Spencer, Royal Caribbean Cruises, a lot of names that you've heard of. Every one of them that was downgraded, mainly in March, April, and May, although some continuing now, had a Z-score below triple B bond rating equivalent. Every one of them that we could get data on. And most had a Z double prime score below. Moral of the story is, we don't know yet what's going to happen, but already this year, our estimate is something like $250 billion have been downgraded. I predicted $600 billion over the next 2 years when we did it back in April, and we published a paper, which is also, Tony, I think I sent you that paper that maybe you've distributed or you can distribute to the group. That paper was published in June, but we forecasted in May about 600 billion. Okay, you have to wait until the end of 2021 to see if we're right. But I think we're going to be closer than the rating agencies was estimated, about 250 billion to 300 billion being downgraded. And when you get 600 billion entering the junk bond universe, so to speak, you could get a crowding out effect. And a crowding out effect means that companies that normally would have raised money get crowded out by the big brothers who enter the market, the triple Bs. Let me conclude by going to the last slide, Tony. Keep going. I'll tell you when to stop. That's it. Go back one. Some recent observations. High yield bond new issuance, record levels. As of the first of this month, 360 billion plus, up 65% from 2019. The highest year ever was 2012 before this, when it was 345 billion. So we're already at a record, and it's only growing more. Junk bonds have continued, the high risk companies have continued to be issued in huge numbers during a pandemic, during a recession, unprecedented. Investment grade new issuance was 1.8 trillion by November 1st, up 72% from 2019. So this, despite the fact that we're in a recession, we've had the bond market, the equity market rebounding, primarily first from government support, and more recently from the aspect of the vaccine, and also the likelihood that we won't be in a recession too much longer. We expect the recession to last at least until the first quarter of 2021. I don't know what the GDP will be at the end of this year. I'm not a macro forecaster, but most people are thinking around -3% for the year. Default rates are still trending up, although not as much as they were early in this year. The bottom line is the Fed has been successful. Unquestionably, they have been successful with their support, buying bonds in the secondary market, supporting government securities, supporting ETFs, direct lending to small businesses. But the unintended consequences I'm concerned with, that corporate debt is rising to alarming levels. There's a silver lining out there, and this is the way I'll end. There could be, but I don't know how much it's taking hold yet. And that is debt buybacks on the part of companies that do not need all that new financing, and new equity issues when the stock market is booming, to lower the debt equity ratio of companies, to take advantage of the boom in the capital markets when they can. With that silver lining, sorry I've gone so long, but Robert, I'll turn it over to you now. And hopefully a number of you have stuck with me here over this period of time. Thank you very much.
Yeah, thank you so much, Professor Altman. Just incredibly interesting. So, prior to this, we had a number of our attendees here submit questions, a few of which I've selected here that were not covered during your lecture, which I'll go through, and then hopefully we have a few spare minutes where we can open it up to the audience to volunteer questions as well.
I'm with you as long as you want, but I know I've been over an hour already.
Thank you very much. It's very generous of you. So just to start, I think as we look across the landscape of, where COVID has hit particularly hard in the markets, the real estate sector jumps out as one, particularly in the office space and sectors. And we were curious whether you had any thoughts on the systematic risk that may pose to the broader economy, or generally thoughts on that sector.
It's interesting that you highlighted quite correctly the commercial real estate sector, because if anything, the personal residential is booming again, much quicker than most people factored in their forecasts for the economy. And that's, of course, a function of the pandemic and people looking for homes that are outside the city districts. But quite right about commercial real estate. That's a big, big question mark. It hasn't suffered as much as we all thought, because although very few people are returning to their offices to work, the companies are still paying their rent, except of course when they go bankrupt. The estimates are 80 to 90% are still paying their rent, even though there's nobody in the buildings. But there's no question that real estate in, particularly commercial real estate in cities like New York and other places, are going to be stressed for quite a long time. It all depends on the sustainability of their tenants to continue to pay, and that's why a bankruptcy prediction model is pretty important for the real estate people. Extend that over to the mall operators. So what's happening in the mall industry is quite incredible. Also, I'm no expert on real estate, by the way, but what I read a lot is that some of these mall operators are actually saving companies like JCPenney from perhaps liquidation to shore up their big anchor storefronts. And the question is, how long can they support a JCPenney that has very few people in the stores by either buying them out, buying their brand or whatever, but that's happened. And then there's been consolidation in the mall operation area. And these are big, big players. So you're going to see a big concentration issue among the big guys. The little guys, the little malls are going to go out of business or are going to be bought up at very attractive prices for the big guys. But the retail industry is definitely in trouble. There's no question about it. It was in trouble even before the pandemic with firms like Amazon and Walmart or whatever dominating them. And now it's only been exacerbated. So I think, yes, that's one of the sectors that's going to continue to have bankruptcies. How many of them were saved by PPP? I don't know. I think there was an article today, I didn't read it, but I was referred to, of how many PPP companies actually have gone under, even though they got the support, and that that program hasn't worked as much as they thought it was going to. But at the same time, it is an issue that I think will carry over, particularly into the second half of 2021, which brings me to another issue is, in some industries, they can pass along what I think will be an increase in inflation in 2021, maybe up to 3 to 4% by the end of the second quarter. Now, the reason why I say that now is I don't think that's going to be the case for commercial real estate. They're not going to be able to inflate their prices as some other industries will. And so that's another lingering problem for that industry.
Interesting. Maybe as an extension to that, you previously mentioned you foresee the second wave. It sounds like you're alluding to real estate being one component likely of that in the back half of 21.
Yeah.
What other industries do you see present in that composition of the second wave?
Well, I guess a continuation of some of the industries that have been in trouble. Travel, maybe travel will come back faster than I thought with the vaccine, but that's going to take a long time for travel to come back, and the weaker ones I think are going to, like some of the cruise lines, are probably not going to make it, or they're going to need to be restructured in bankruptcy and get rid of a lot of the debt in their capital structure. The irony is, Robert, as you may know, even these companies have been able to raise debt in this COVID-19 period, like Carnival and Royal Caribbean. They've raised a lot of debt, and that was on the supposition that cruise ships would start operating successfully starting now. but they're not. They can't, especially since they tried outside the United States and they had to be called back with COVID cases. So I think that's an industry, travel, that will continue to have trouble. Yes, it'll improve once the vaccine kicks in and people start traveling again. I'll give you an example. I'm scheduled to go to Hawaii on my annual retreat in December. But I'm thinking I'm going to defer it. You know, look at the level of cases now. And I'm really seriously thinking about that. And the longer I defer it and other people defer travel, that makes all but the strongest in trouble. And there'll be more consolidation in airlines. There already is a lot of foreign airlines that have gone under, Avianca, LATAM, et cetera. Other industries, communication industries, are going to be under stress, particularly, you know, regional, local newspapers, et cetera. Retailers. Look at New York City. We're both in New York City, right? Well, I'm not in the island now, but you walk around New York City, you see how many restaurants have closed, and they're not coming back, a lot of them. So that's another one. Maybe they're smaller than the big guys. Oil and gas. Well, one thing we're seeing with oil and gas is they're continuing to go bankrupt, but also there's been mergers, and maybe the consolidation will be the savior. But, you know, oil and gas is in trouble in general, so they're going to be continuing. What else? You know, like I said, retailers, restaurant chains. Some will make it, some won't. Yeah. Anyway, but I'm encouraged by the growth in the economy, but we're paying a price. And I'm encouraged in terms of the numbers, but this fourth quarter is going to be strange with in terms of kicking in growth, but at the same time, with this surge in cases, spike in case numbers, with the lockdowns that are beginning to happen, I think that you know, we're going to have some trouble with the economy.
Thank you. Maybe if we move it back to your model, credit ratings, and predicting actual defaults. I mean, you spoke a lot about your scores and what credit tranche they tie to shifting over time.
Yes.
I'm curious, is some of that related to loose covenant structure and potentially incentives that credit derivatives inject into the market that may differ from someone that just holds a cash bond? And if you have any view there.
Well, one thing, some of my colleagues at NYU, one in particular, Marty Subramanian, has done some research and concluded something that I felt intuitively, that the advent of credit default swaps has actually increased bankruptcies than what would have been the case without the CDS market. Clearly, it's beneficial to those who take out insurance through any CDS purchase and the company goes bankrupt and they end up getting 100 cents on the dollar. But it also motivates bankruptcy more and default events more because of that situation. So that's the CDS. What was the other one that you asked?
The covenant structure. I mean,
yeah.
Obviously in the market, there's been a lot of examples of companies pulling various maneuvers to, you know, kick the can down the road, if you will.
Right, right. And it has done that. It has kicked the can down the road. And that's maybe one of the reasons why the default rate hasn't gone up as much in the COVID-19 period as many people thought. The kicking the can down the road only works so long. And now we've got this concept, which I didn't get into, Robert, in time. I'm sorry I didn't get to it, the zombies issue.
Ah, yes.
Well, I recommend everyone look at, maybe with some skepticism, a current article that came out today in Bloomberg on zombies. And what they found is enormous growth in zombies in the US economy. And they define a zombie as a company whose coverage ratio is less than 1. And even big companies like Boeing and Delta Airlines, they may categorize it. I think that's too extreme. But the point that was made is that, and I think this is linked to this covenant issue, is that zombies, and I define a zombie as a little bit longer company that has been being kept alive artificially through covenant light, through interest-only loans, through a very benign credit cycle period, that the zombies have increased in number dramatically. Deutsche Bank did a study that said 20% of listed companies who've been around for more than 10 years and have coverage ratios, EBIT to interest, less than 1 for at least 3 years. There's a lot of filter there. These companies, probably some of them, in fact, they probably should have included them, had been receiving loans, covenant-light loans. And so they've been kept alive, so to speak. Now, how long will the banks continue to support them through the leveraged loan market? And I think it will happen as long as the CLO market continues to absorb those loans. So then it's the ultimate investor who takes the risk and hopefully gets enough return to calibrate it for it. So yeah, I think all of that, this leniency in the market, this benign cycle, risk on, it's got to come back to haunt us in one form or another. And I'm just hoping that even these firms see the light and, if they can, start paying down that debt before it's too late.
Yeah, thank you very much. As far as our submitted questions go, I think we've fairly comprehensively covered the majority of topics there. So, maybe we can, if you have a few extra minutes, cap the time at 1:45 and 10 more minutes to open the floor if people want to, if that's okay with you, first of all, and then folks want to raise their hands, I'll call you and you can come off mute.
Yeah, we have 62 people left, so that's still a nice number after all this. Thanks for hanging in there. Sure, if there are any questions, you can have them speak out, unmute them, or how do you want to do it?
Great. Yeah, can you hear me, Ed?
I can hear you, Terry.
Okay, yeah, I got a couple. I mean, first of all, very enlightening, seriously, on both historical and the effects of COVID, really. But I have my question gets a little more technical because I got really two questions. One is, when we look at numbers like you present on the amount of debt outstanding and things, right? And how many billions are defaulting this year relative to last year? How important are considerations like the inflation rate and the size of the debt in real money terms increasing, for example? Meaning if debt is larger one year than the previous year, if you take inflation into account, is it the same, or is it really the real, the real interest rates, and then the percentage of debt out there relative to what was out there previously? And then the second question is a little more technical, but I ran into it as an analyst at Citibank when I was looking at, just as you were saying, the GM defaults. I was looking at, I had the KMV model at that time, and basically, if you look at it, and KMV wanted to sue me over this, so because I wrote about it, and basically they predicted almost almost no decline in credit quality, even as their CDS values were going up, and they're the kind of company that also had a financial institution attached to it, and the models, unlike the Z-score, basically, and your Z-score really tracked it very well, but KMV's missed it totally. And so whatever is in their model, in some ways, I sort of know why they did it, actually, but how do you handle companies that have like a separate finance wing and a manufacturing wing?
Okay, well, I'll try to answer the second question first. You're talking about captive financial subsidiaries like GMAC in the case of GM, or General Electric Credit when they were an integral part of General Electric. So I've come across that issue in the past, and what I try to do is estimate the Z-score with and without the captive sub financial subsidiary. IBM is another example that I looked at carefully, as well as GM with that, and found that while in most cases, but not all, but most cases, the Z-scores were lower if you include the financial subsidiary than if you don't, because of the enormous amount of debt that the captive has. And that explains why GE got rid of it and GM had to get rid of it, is that they were, even though they were thinking they were important to selling the product, having the financial subsidiary finance the purchaser, it became such a burden to them that they had to spin it off in one form or another. But I was looking at Z-scores with and without. So assuming that they did spin it off, how would they look without it? And then you kind of do a pro forma Z-score on the company without it to see, you know, what would it look like without it. And so that's the way I handled the captive sub. The one thing about the captive sub that saved GM, though, is that they were eligible for the loan from the government because of the captive sub. They would not have been eligible as an operating manufacturing company because the money came from, what was the acronym that was used then for the $800 billion government?
TARP.
Sorry?
TARP.
Yeah, that's it, the top loan. That's why GM got the loan, because they were top qualified. And Chrysler as well, although the Chrysler was a, you know, it was a 363 sale in their bankruptcy. But so that's the issue with respect to how I'd handle the captive sub issue. Your first question is a tougher one and a good one, the inflation question. So we haven't had, as you all know, any sort of inflation for a long time. And so the real interest rate, you know, when spreads dropped to 400 basis points on high yield, the real rate between that and the government rates were still reasonably high then. And what I think will happen, although I'm no expert on this issue, but it was one of Robert's questions also, is what's going to happen in the future. Now, I think two things could happen. One is interest rates will remain very low because the Fed will keep them low. And I'm talking about government rates and the Fed lending rate. But the real economy's inflation rate will increase. That's my forecast, a fair amount in 2021 from the very low level that it is now. Now, you may disagree with that because companies have to have the ability to pass along that to their customers. So the industries that can pass it along are going to have less trouble with meeting their interest payments, which are very low from the past. But if you can't pass it along and you're in a still in a deflationary cycle in your own industry, and then the cost of new financing for them is going to rise because the real rate for those companies will go up, then I think you're going to have those companies most at risk given the high amount of debt that had been raised. So maybe Terry, you're a lot better than I am in terms of actually getting to the nitty gritty of it, which companies and within each industry are best positioned to take advantage of the higher inflation rate coming. But that would be one way of looking at it. I'm wondering what you think, Terry, because you're a seasoned professional in this field. And even what your thinking is on this.
Well, put it this way, I'm just trying to disentangle, those effects from the general effects and their importance on the numbers that you give historically and on why the Z-score numbers and their default probabilities have evolved over time to where now 0 rather than 2 point something.
That's right.
Is that, and I'm just wondering how much of that effect might have been due to not correcting for those kind of factors, if any effect. That was the question that came up in my mind, which caused me to raise it right here. And then where are we now with respect to to historical levels? That's all.
Well, don't forget Z-score.
What? Yeah.
Z-score does have retained earnings and EBIT in it. It's not just and market value of equity. So there are many factors in Z-score that could compensate for the fact that you're quite right. Interest rates will be very low. Interest amounts will be low because of the low interest rates that companies were favorably take advantage of in the last couple of years. So that's the beauty of a multivariate approach if you have compensating factors in there. My concern is what happens to the companies, even though the stock market has come back as much as they have, whose equity does not recover like the market. Up to now, it's been a broad base, but value companies have not recovered nearly as much as the growth companies. But that might switch quite a bit, so that would be another factor.
Okay, and just a related question actually that reminded me of something that came up while you were talking, was that companies which is, well, two things. One is, first of all, the ratio of equity to debt is sort of, you could argue, inflation adjusted. So meaning that ratio shouldn't have a problem with inflation, and that's one of your main things. But if I'm a company and I'm figuring out if I take this action, how will my Z-score change? What do they do for the market value of equity? How do they estimate, meaning the other variables you could probably estimate by the changes you make in your structure, but how do you figure out what your equity price is going to be if I do this action?
Well, I go back to Graham and Dodd on that. You kind of normalize some expected earnings and assume a reasonable price earnings ratio in the market for those kind of companies. What's probably a good idea to do is do some sort of downside scenario. And that's what I've done. I have some slides that I didn't have time for today. I looked at what happens to debt equity ratios back in 2019, and now we have the data to do it as of the end of 2020, if the stock market has another big decline. I'm not saying we will have it, but let's say it drops by 20 or 30% as it did last March, maybe because of some other catalyst that we don't forecast right now, but could happen. I look at debt equity ratio in market value terms, assuming a drop in the market of 20, 30, or even 40%. And I don't have the slide in front of me, Terry, to show you, but it showed that in 2019, when the stock market was still pretty high, as you know, and the debt levels were high, book value, that the debt to market value of equity ratio was reasonable, even lower than it's been for the last 12 years, well, since 2010, 2008. But if you simulate the drop in the market in general, and then of course you superimpose on it the firm that you're analyzing, their debt equity ratio could be much, much higher or worse given a downturn in the market. So that's the way I'd handle it. The beauty of a model like that is you can do some nice pro forma analysis. And then you leave it up to, your experts to say which is more likely to happen. But you have a stress testing methodology built into the model.
All right, thanks. Yeah, no, that seems reasonable, right? You could say under these equity scenarios, this is how changing this other structure of my debt and liabilities and so forth would work. Okay, but you gotta that variable, you're gonna have to do your best to just try to figure out what the future is like. Anyway.
Okay, well, it's tough. These forecasting is tough to do, as I said.
Very interesting questions, Terry. Thank you. Professor Altman, would you be okay if we open the floor for just one remaining question?
Yeah, one or two, as many as you like.
If any folks want to speak up.
Professor Altman, thank you very much for this enlightening talk. One of the things, I'm in industry, one of the things that was interesting to me was to see the conditional probabilities as you move along in time. But one thing that struck me is that is implicit in that methodology, the fact that you're going to remain a single B or a triple B throughout the life, so that if a company moves up in ratings, there's a change to Z-score, and therefore the cumulative probability is going to be a lot different in the end.
That's a great question, if that was a question, but it's an accurate observation, and it points up to a research that I wish I had done. And so let me explain what I mean. When we built the mortality model in 1989, we only looked at, as you correctly surmised, the original rating, and then estimated at that point in time the probability of default for 1 to 10 years. That assumed nothing about the migration of the risk over that, whatever horizon you were interested in. So you could ask yourself the question, is a company that was triple B at birth that has migrated to single B the same risk of default or downgrade as another company that was single B at birth and still single B after 3 years, say? In other words, a B is a B is a B is a B, so to speak, regardless of what its history was. And so what I would have loved to have done, I didn't have the resources at the time, and each time I wanted to do it, I found that it was very difficult to get all the data, but it's certainly possible now for perhaps someone else to do it, is a lot younger and more energy level, perhaps. But is to look at contingent probability given a migration from triple B to B. We all know that the probability of default, of a downgrade of someone of a firm that has a bond issue that has migrated to B is higher than one that has remained B, even though they're both Bs. And the rating agencies would say the probabilities are the same. But if you look at migration patterns, the contingent probability of the next rating change being in the same direction is very high. I think we call that autocorrelation. So quite right. What would have been even better is to have a seasoned issue with a migration pattern and then built in the matrix of mortality rates from that. I can tell you that I've done it kind of, what's the word, casual empiricism as opposed to rigorous one, and find that it's quite persuasive that, in fact, I can ask you as a professional, what do you think the probability is of a company that has been downgraded, let's say from double B to B, or pluses and minuses now, the probability that the next rating change, if there is one, is going to be in the same direction as opposed to an upgrade? So is it more likely that the next change will be in the same direction or in the opposite direction?
I would think that if a company was upgraded, that the next move would be an upgrade as well. In other words, it'd be momentum.
Okay.
But the probabilities would keep declining. So
What about the downgrade? If it's downgraded, would it be likely to be the next grade change to be another downgrade?
yes.
Yes, absolutely. Next question. Which industries do you think that probabilities would be even greater? In other words, I can tell you my empirical research, which is now 20 years old, so we need to update it. I found the probabilities ranging from 2 to 5 times greater probability of a downgrade following a downgrade than a downgrade followed by an upgrade.
I wouldn't think it would be manufacturing. I think it would be things that are correlated with prices. So commodities, as an example, energy companies.
Okay, but the biggest industry, what industry would you think would have the highest autocorrelation or highest probability of a downgrade?
I don't know.
Banking.
Not surprising. To me, it would have been more mean reverting.
Yeah, the reason is that debt is what, 80+% of the capital structure. So when you get downgraded, your cost of debt capital goes up. And that's a very big part of your expenses compared to let's say an operating company that has 20% debt, 10% debt in it and gets downgraded. Plus, so I'm thinking that, anyway, we found that this was a while ago, a guy, I did this study with a fellow named Tony Cow. I don't know if that name means anything to you, but he was the #2 guy at at the General Motors Pension Group before he formed his own advisory firm. So I did that study and we found that banks, well, financial companies in general, were 5 times greater probability, once you observe a downgrade, 5 times greater probability of another downgrade rather than an upgrade, whereas the average manufacturing company was like 2 to 3 times. Anyway, that's what our empirical results were. But your question is great. I still think someone should do that. Maybe nobody wants to do it because they think, well, they wouldn't get the academic, I'm talking about academics now, they wouldn't get the academic credit for something that's an extension of what I did, a long time ago, as opposed to something really new and innovative. But I think that study would be really important because then you could feed in that kind of information to get a better contingent probability.
Thank you very much for that.
You're welcome. Thank you for the suggestion.
Is anyone interested in submitting one last question before we wrap up today?
If I could just throw in a comment on that, I think it's completely right about the banking. And I guess maybe just to extrapolate a little bit, for an insurer to go from AA to single A, they're going to lose some clients. To go from single A to triple B, they're more or less out of business. So yeah, that matters.
Absolutely. Do you remember, we have a backup there, maybe you got, do you remember a firm called CapMac? Who was it that asked that question?
Sorry, it's Howard Blom.
Howard, I don't know what age you are, Howard, but there was a firm called CapMac. I can't see your photo because you're, I don't see it. Have you ever heard of a firm called CapMac?
No, I'm not familiar with them. You can guess my age because I don't show my photo.
Okay, well, CapMac was one of the leading bond insurance companies back in the 90s. And it wasn't, MBIA was the leading one, but CapMac was up there. And they were an insurance company, had a AAA rating, but bond insurance, not life insurance or casualty. And anyway, they were downgraded because they had a huge exposure in the 1988, 87 to South Korea, and they had written insurance on South Korean government bonds. And South Korea was downgraded from AA to BB in a very short period of time, and they didn't have the capital, CapMac, to make up for that exposure, and so they were downgraded. And then you're quite right. They would have gone out of business, except they merged into MBIA. It was fortuitous, although the price was much lower when that came out. That saved the shareholders, but the company went out of business. So you're quite right about the insurance industry in that respect. Robert, I think we're probably long overdue. We're almost at 2 o'clock. It's lunchtime for everyone. Thank you very much. I hope that you get good feedback, and by all means, Tony, you can send people the COVID-19 article or the 50-year retrospective article, or both, and the PowerPoint for anyone interested.
We'll distribute the material, and would like to thank you again, Professor, for coming to us.
Thank you for the invitation. Good luck.
Thank you very much. Take care.
Thank you.